the author of a new best-selling book, The Great Depression Ahead. Economist Harry Dent joins us live from our New York City newsroom. Harry, good morning.
Nice to be here, Megan.
So just reading your bio, it's rather impressive. You are very well respected. You've predicted all sorts of things that have happened in this country and other countries. When everybody else told you you were going to be wrong, you turned out being right. And I'm sorry to tell our viewers that you are one of the ones who is predicting that this recession will lead to another Great Depression?
Yes, this isn't just a banking crisis. It's the peak of the massive baby boom generation's entire spending cycle. And for many years to come, they're going to be spending less, saving more. This is something we can predict very reliably with demographics.
Wait, so you think it's the retirement of the baby boomers that's really gotten us into this mess?
Well, people peak in their mid to late 40s and spend less as they prepare for retirement. So that's the first trend that's happening. But we are also seeing the early baby boomers accelerate in retirement. And that's even worse because they leave the workforce, don't pay payroll taxes, don't earn incomes, and require benefits. So all the demographic trends are down for years to come.
All right, if you think we're actually headed for another Great Depression, when is it hitting, and what sort of numbers are we going to be looking at?
First of all, I think we're probably going to get a bounce in the markets the next 3 to 6 months. People should use that to sell their stocks and 401k plans, get liquid and cash. Same with real estate, they wish they sold. We expect a bounce into late this year, early 2010 at the latest, but then the economy turns back down. We're expecting stocks will go down to something like about a 3,800 Dow, give or take, and housing should go down to 2000 levels. Now, that doesn't sound like much, but for places like New York, San Francisco, Miami, that's a lot lower than you think.
A 3,800 Dow, as we look at the big board, and it's at 8,000 right now. What does that mean for our viewers as a practical level? If you are right, what should they be doing? Look at this. Look what you're doing to the markets right now as we talk, Harry. Down below 8,000. What should people be doing with their money?
I'm here to sell books. I'm here to sell books. I'm here to sell books.
Well, again, this is a situation where all assets go down and investments, bubbles are bursting. That only happened in the 1930s. So you have to sell out as things move up, like stocks. We expect to move back up to 10, maybe 11,000. Sell and just go to cash, hold that cash for the next few years, and let this deflation and banking crisis play out, just like in the 30s. Your money goes up in value. Same for real estate or anything else you own that you don't need to keep long term.
Let's get this new information, though. How about this for a prediction? A market crash coming in the third quarter of this year, and the U.S. is headed for bankruptcy? How about this for a prediction? A market crash coming in the third quarter of this year, and the U.S. is headed for bankruptcy? And the U.S. is headed for bankruptcy? How about this for a prediction? A market crash coming in the third quarter of this year, and the U.S. is headed for bankruptcy?
That's how Harry Dent I was so taken aback.
Yeah.
That's how Harry Dent of HS Dent Investment Management says, Happy New Year. He is the author of The Great Crash Ahead, Strategies for a World Turned Upside Down. Harry, come on, man. I mean, that seems a little bit over the top, doesn't it? Harry, come on, man. Harry, come on, man. Come on, man.
How many crashes have we seen in the last 10 years or so? 2000, 2002, bubble crash. 2007, bubble crash. We're getting a bubble and crash about every 4 or 5 years. So this is
Come
what
on,
we
man.
have. We're never going to see real estate prices at these levels again, and we're not going to see stocks at the levels we saw in 2007 for a long time. So to me, this is not
Come on, man.
We call this the economy in a coma. I guarantee
So what's the catalyst?
both of you.
What's the catalyst?
Come on, man.
Stimulus for 1 year, and this economy died. The second half that we think a crash starts, that just like the last crash, lasts about a year and a half or so, goes into late 2014, early 2015. We get a slight new high in the Dow this year, and then we get a slight new low in the next crash. That's been the pattern.
Hey, come on, man. That seems a little bit over the top, doesn't it?
Do I agree with Harry that the world's going to come to an end this year? Harry, it's just not going to happen.
How's 6,000? How's that for a bearish call on the markets? We are at 12,876 right now. That is what Harry Dent, author of The Great Crash Ahead, is predicting by 2015.
Robert Malthus, the economist in Britain, taught us that demographics do not have a very strong predictive value, particularly when it comes to markets. Look, in 1998, Harry wrote a book saying the Dow was going to 35,000. In 2009, he wrote about the Great Depression that was ahead, and the S&P's gone up 110% off the lows, and the economy's gone to new highs in GDP, retail sales, and car sales have rebounded rather nicely.
You running for office?
No, absolutely not. But I would not predict stock market trends based on some of the factors that Harry cites.
Hey,
and I would,
Ron, you and this guy don't know what you're talking about.
Imagine living in an economy where it is possible to predict with much greater accuracy how the markets will perform, when we will have booms and busts, and when and where to invest for the future. Imagine business people and entrepreneurs knowing when product sales will grow in different sectors, including the growth potential in every city, state, or country. This shouldn't seem so strange in a world where we can predict the movement of the planets, when the sun will rise and set, the precise ebbs and flows of the tides. So why can't we predict the ebbs and flow of our economy? The truth is, the more we learn about things, the more they become predictable. That is the history of mankind. We will never know everything, but the more we can predict, the more we can manage, program, and automate things to increase our standard of living and reduce the many risks and uncertainties that seem inherent to life. Economics has become so complicated that it has failed at its fundamental mission, predicting the future. But I'm here to tell you that it is far more predictable than you think and have been told. The economy can be forecast without knowing anything about money supply, interest rates, currency exchange rates, capital formation, or endless government policies. It means that you and I can know when and where to invest for our future, whether it is our children's education or our retirement. It means we can know where to find the lucrative and challenging jobs. And ultimately, we can live without the great levels of financial uncertainty that presently plague us. My name's Harry Dent, founder of Dent Research, and I am here to show you how our proven method can allow us to forecast the economy years or even decades in advance. Yes, you can see the key economic trends that will impact your life, your business, your investments, and your family decades in advance.
Look at my eyes right here. Come, give me a close shot, will you? And look at these eyes. I have never lied to you. Never. I never will.
We use demographics to forecast economic events and business trends with remarkable accuracy.
I have never lied to you.
Why? Because people do predictable things as they age. Now many economists and financial advisors, they say this isn't possible. But our track record speaks for itself.
I have never lied to you.
Obviously, for people who've followed us for a while, we are starting to see a once-in-a-lifetime event, something we've been forecasting now for 20 years, since the late 80s, early 90s. We've said, this baby boom-driven incredible boom and bubble boom would come to an end around the end of this decade, and we would enter the next Great Depression. In fact, we said, I think it was on page 16 of the Great Boom Ahead, way back in 1992, this would occur between 2008 and 2023. So We are starting to go through a long downturn, a deflationary or the deleveraging of the credit system and all the bubbles we've had, much like Japan went through in the 1990s and early 2000s, and of course our demographic research in the late 80s.
Hi, I'm Harry Dent. Just wanted to give you an update since our book was published. People are not aware that the manuscript for that book was completed in May of 2008, and the book was finally published in December of 2008. And obviously a lot of interesting things have happened since then, mostly in line with our forecast. One of the biggest changes, though, was that oil prices and commodity prices from July of 2008 into late 2008 collapsed faster than we or anybody saw because hedge funds were
But our track record speaks for itself.
Hi, I just wanted to post a brief update as of October 14th because we're at a critical point here in the markets. I think people who've been following us and read our book know that we've been expecting a bear market rally into late summer, early fall. We were originally expecting this would last at latest mid-September, and we first got a little top at September 23rd, but now we're retesting those areas, and the markets look like they well could continue to go up. Now, this is pretty unprecedented,
but our track record speaks for itself.
Because we've studied other major bear markets, like in the early 1930s and in the late 1930s.
But our track record speaks for itself.
So this market should be running out of steam, but then we look at a lot of our short-term indicators that we cover in our newsletter about whether the market's overbought or oversold or, ready to correct or go up again. And it's saying, we got overbought here on the way up a number of times, but right now there's nothing screaming that the market should top. So we've now basically come up in our recent newsletter and updates to, hey, there's two scenarios here. We could be topping here in mid-October. Our short-term cycles suggest it's more likely the market would correct into November, bounce back up in December, and then correct again in January. Those are just cycles that help us refine it. Nothing says that has to be. But that would be the suggestion. So the real question is, in scenario one, if we get a more extreme correction here into early to mid-November, 2,000 points or more, let's say down to Dow 8,000 or something like that or lower, that would say, yes, we put in a top in this bear market rally and this is the first wave down, and it could go lower than that. That's been our preferred scenario thus far.
But our track record speaks for itself.
The second scenario would say, no, let's say we just take mild correction here and go sideways for a while, and the markets could continue to go up. Our next kind of up cycle is into late December, early January, and that's probably likely to be as late as this market goes, we would assume.
But our track record speaks for itself.
If the market kept going up at the same rate it's been going up, about 500 points a month, it would be up. That's scenario two, and we're going to be looking in the next couple weeks in our newsletter and our analysis about, hey, are we topping here, or are we likely to head higher? Because people may want to get back in the market for a while.
Hey, Ron, you and this guy don't know what you're talking about. Hey, Ron, you and this guy don't know what you're talking about.
But our track record speaks for itself. But our track record speaks for itself. But our track record speaks for itself.
Hey, Ron, you and this guy don't know what you're talking about.
But our track record speaks for itself. But our track record speaks for itself.
Hey, Ron, you and this guy don't know what you're talking about.
But our track record speaks for itself.
Hey, Ron, you and this guy don't know what you're talking about.
But our track record speaks for itself. But our track record speaks for itself. But our track record speaks for itself. Oh, hi, this is Harry Dent. Just wanted to give another general update on the markets. As people are aware, in our book, The Great Depression Ahead, we expected a strong rally in the stock market. We expected a bounce in the economy in reaction to strong government stimulus, which has all occurred. But, you know, this bounce and this recovery thus far has lasted longer than we would have normally thought and longer than any bear market rally in the last century. We've studied them all. It's very rare to see. Most bear market rallies, big ones like this, last 5 to 8 months. Well, we're, you know, well into this one.
Hey, Ron, you and this guy don't know what you're talking about.
It's probably going to last a year or a little longer before it's over at this point. And what we do, and this is an important part of our newsletter, in addition to all the demographic research and updates and our different longer-term indicators in our research, we also look at short-term trends and help people time short-term decisions or even long-term decisions that need to be timed short-term at your best advantage. And our technical indicators back in August of last year were saying, you know, maybe this rally's getting overdone. This was back when the Dow was kind of more like in the 9,000 to 10,000 range, and we started giving warnings. Hey, this is in our time frame. This is in the.
Hey, Ron, you and this guy don't know what you're talking about.
Hi, this is Harry Dent with an update on May 11th. We are seeing a peak in the markets between a Dow 11,300 on the low side and 11,800 on the high side, and between late June and early August. We'll obviously have to narrow down on that. But our track record speaks for itself. Hi, this is Harry Dent. On July 13th, 2010, this is the update we've been looking to put out for a long time, for many months. We've been looking for this bear market rally in stocks to top and to warn people the best place to not only sell stocks, but for more aggressive investors to actually short the stock market and bet against stocks, and we're seeing that now.
Hey, Ron, you and this guy don't know what you're talking about.
In our last YouTube update in May, we were looking for one more rally to new highs, but since then we broke some important support at 1,040 on the S&P 500 and 9,780 on the Dow, which says something's wrong here. But we also warned in our newsletter after that break that we could see a bounce back towards the highs in June, around 10,600, before we actually come down again. So we're seeing that now. But our track record speaks for itself. Hi, this is Harry Dent. We just wanted to give an update since our July YouTube video. Obviously, the market top we saw forming back then was not a top. The government has come up with a stronger new policy, which they call quantitative easing. Now, first of all, to understand what this is and how it's different from other policies, the Fed always has two tools for stimulating the economy. The first is the one we normally see. But our track record speaks for itself. But our track record speaks for itself. Hi, this is Harry Dent. Just wanted to give another update here on February 22nd. In our newsletter, we've been looking for a short-term top and the first significant correction in a while to come somewhere between mid-February and mid-March. And this may be starting here on the 21st and 22nd of February. We've got riots and violence in 7 countries across North Africa and the Middle East. But our track record speaks for itself. Hi, it's Harry Dent. with another update. Given the surprising little crash in August, but our track record speaks for itself. First, I want to let everybody know that we have a new book coming out. I've co-authored this with Rodney Johnson, president of HS Dent. It's called The Great Crash Ahead, and it's going to come out about September 20th. So a lot of people may want to get on the pre-order list at Amazon to get that as soon as possible. You can probably get a little earlier, and I'll also mention that at the end here. And just to recall, our last update was in February, when we had been in a position of kind of looking at the markets continuing to go up longer than we originally thought in the Great Depression Ahead book, because of, the QE2 to follow the QE1. I mean, the government has just had endless stimulus here. And in more recent months, we've been looking for a scenario much like the tops and the bubbles. But our track record speaks for itself. Hi, Harry Dent on January 11th, 2012, with an update. As all of you know, we've been looking for a long time for this rally to come to an end. It's an artificial rally from the Fed and government stimulus. Baby boomers, as you know, have peaked in their spending back around late 2007. We had $42 trillion in debt, started to deleverage there, but of course the government threw trillions of dollars, loan guarantees,
But our track record
QE1,
speaks
QE2,
for itself.
TARP and everything to stop the financial system from melting down. But all it has done is pushed money into the banking system that has not been lent. It's been reinvested, often at high leverage, creating a third bubble. Commodities, stocks, bonds, junk bonds, gold, silver, oil, all going up at the same time. It's called the risk on trade. We think this risk on trade is getting ready to end, either here in January or at the latest mid-March. And we've been telling in our newsletter recently for people to be a little ahead of the game, be getting out of stocks here. This is the time finally to get out. Now there's a number of reasons.
But our track record speaks for itself.
First, good way to picture the baby boom, just a little more insight. Again, the peak in spending comes at age 46. The baby boomers hit that in peak numbers in late 2007. But there's a plateau into age 50 as the kids are getting out of the nest from high school to college.
But our track record speaks for itself.
Hi, this is Harry Dent on June 19th, Tuesday, with an important update. There's a time for an investor or to make a decision about getting out of an investment. And we think this is the time for stocks. We have the markets rallying this week on hopes of further Fed easing. And of course, as we say, the markets on crack always want more crack. So that's the number one priority for the markets. And then we just had this Greek vote over the weekend. It wasn't as bad as people assumed, and it looks like they'll be able to get some type of coalition.
But our track record speaks for itself.
But we say probably Wednesday afternoon or Thursday, Friday at the latest, is the time, if you're still holding stocks, especially people holding high dividend stocks, thinking, the dividends they need for income in this time when it's hard to get yields and stuff. Our advice is get out of stocks altogether or greatly reduce your exposure because, again, we're seeing rising chances of this kind of great crash ahead we've been predicting now for a couple of years. It looks like we're about to hit that bang moment in.
But our track record speaks for itself.
9th with a market update. If you've watched us on CNBC and other programs,
Hey, Ron, you and this guy don't know what you're talking about.
We've been looking for a peak later this year, probably mid to late summer, and some type of correction before that. Well, we just had some important surprises in the markets. Number one, we've had this megaphone pattern in the S&P 500 where we've gone a trend line towards the tops and the bubbles in 2000 and 2007 that hit at 1,600 right here currently. We broke above that. Now, that's the first major U.S. index to do that. The Dow and the Dow transports hit higher, about 7% higher, around a 16,000 Dow, probably later this summer. But this was a key break, and it means even if we correct a little bit near term, stocks are probably...
Hey, Ron, you and this guy don't know what you're talking about.
Stronger resistance and more charts. Hi, this is Harry Dent. Just want to give a quick update after the recent Fed meeting in September where the Fed actually surprised the markets. I mean, the markets were actually ready to have the Fed taper $10, $15 billion a month, cut back their stimulus program and not punish them severely for it, and the Fed did not take that invitation. Very surprising. Now, first of all, it tells me Ben Bernanke's not as confident that we're in a sustained recovery as everybody thinks he is. Would you invest $2 trillion a year to get $350 billion in GDP? That doesn't sound like a very good deal. That doesn't sound like a sustainable recovery. It's not. One of the things I've looked at recently is that there's a 7-quarter cycle in this stimulus. Stimulus doesn't work but so long. When you're putting money in the economy and you're pushing interest rates artificially low, short-term and long-term, what you're doing is encouraging people to buy now something they might buy, say, a year or two from now. You're pushing forward demand into the present. So you're borrowing from the future. And stimulus is borrowing. And the government creating money out of thin air is borrowing. Banks making loans out of thin air against, and since that debt bubble unraveled and since the baby boom, real investments in plant and property to create real long-term jobs for real long-term consumers. Housing's bouncing back, but most of it between mid-January and late March and the next great crash to come. Every bubble's taking us higher, every crash takes us lower. If you're worried about your stocks, your financial assets, you will protect them. And if we don't see a major crash by the summer of next year, then I'll back off and say, hey, maybe the government's pulled another rabbit out of the hat. I think they're running out of ammo. I think the next crash is just around the corner. Thanks for listening.
On December 20th, just before Christmas and looking to the next year, I say 2014 is going to be the most important year for a decade past and maybe a decade forward. I think this is when the bubble that governments and central banks around the world have kept going, despite all fundamentals and despite all responsible banking and federal and central banking policies, this is the year when it burst.
But our track record speaks for itself. But our track record speaks for itself. But our track record speaks for itself. Imagine living in an economy where it is possible to predict with much greater accuracy how the markets will perform, when we will have booms and busts, and when and where to invest for the future. Imagine business people and entrepreneurs knowing when product sales will grow in different sectors, including the growth potential in every city, state, or country.
Look in my eyes right here. Come, give me a close shot, will you? And look at these eyes. I have never lied to you. Never. I never will.
This shouldn't seem so strange in a world where we can predict the movement of the planets, when the sun will rise and set, the precise ebbs and flows of the tides. So why can't we predict the ebbs and flow of our economy? The truth is, the more we learn about things, the more they become predictable. That is the history of mankind. We will never know everything, but the more we can predict, the more we can manage, program, and automate things to increase our standard of living and reduce the many risks and uncertainties that seem inherent to life. My name's Harry Dent, founder of Dent Research, and I am here to show you how our proven method can allow us to forecast the economy years or even decades in advance. Yes, you can see the key economic trends that will impact your life, your business, your investments, and your family decades in advance. We use demographics to forecast economic events and business trends with remarkable accuracy. Why? Because people do predictable things as they age. Now many economists and financial advisors, they say this isn't possible, but our track record speaks for itself. 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 Our track record speaks for itself.